Hit it.
It's Friday, April 21st, 2023, episode 211. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we have the pleasure of welcoming back Vincent Deluard from StoneX. We have a terrific discussion about why the economy might not be as bad as consensus believes, the best way to play the delayed economic weakness, and we find out if Vincent knows his home region of Burgundy better than his adopted city of San Francisco. After that, it's time for Patrick to interpret his cave drawings in Talking Charts.
And then we'll settle up our skin in the game. And folks, we might even drink some beers along the way. Lena, hop on. What beer are Kevin and I drinking today?
So today, the gentlemen are drinking Green Stand Vermont IPA by Mount Holly Beer Company.
Okay.
The Green Stand is a hoppy ale named after the first tavern in Mount Holly, built by Captain Joseph Green, a returning Revolutionary War soldier who settled here in 1786. The tavern was unfortunately taken down in 1919, but its spirit lives on with the beer you hold in your hand.
All right. A special shout out to Daniel Tilley and the Bank of America Delta One sales team for sending us in these beers, Kevin. Listen,
they're terrific.
Yeah, anyone who wants to donate beers, we're always grateful.
This show is brought to you by the Bank of America Delta One sales team.
There you go. All right,
and it's a terrific beer too. Thank you very much.
It's nice,
we really appreciate
it's nice and tropical, fruity almost, like to it, right? No, anyway, let's do some side effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much Huddle may include the Goldman craps, the Netflix chills, and the Tesla terrors. And that was brought to you. Big thanks from Parman Trader. We're not sure if that's his last name or the kind of cheese he trades.
I get those Tesla terrors all the time, actually.
I do too.
All right, let's get to the interview.
It's our great pleasure to welcome back to the show Vincent Deluard, the director of global macro strategy at StoneX. Vincent, thanks for coming back.
Always a pleasure. It's fantastic. Thank you.
I promise not to ask you any Emily in Paris questions.
Good. I'm anxiously waiting for the next season. So there's not much to talk about anyway. I mean,
that's right. We got to get Louis Gav on to ask him what he thought of it. Okay, a lot has happened since we've spoken last, and I guess to some extent, you predicted inflation. We thought that this was going to increase, and one of the consequences of inflation has been increased monetary policy, tightening of the policy. And we saw the first kind of, let's just say, fallout from that policy, which was the Silicon Valley Bank and the other regionals. I'd love to hear what you're thinking there and whether you think this is the beginning of the end.
Well, if I could summarize it in 3 words, I would say it's a rich man's crisis.
I like that, although I don't know if the rich men like it.
Which means that it's going to be very loud because, rich people, nobody likes to lose money, but rich people especially don't like to lose money. That's why they're rich. So we see a lot of fire and fury, a lot of headlines, certainly a lot of huge moves. I mean, you look at the 2-year yield last year. I mean, we went from like 5% to like 3.7% in a couple of weeks. I mean, insane volatility. But I think the economic fallout is going to be less than the kind of panic of last month suggested. And we're starting to see that in the data. I mean, you look at deposits are going back to small banks. Some of the emergency borrowing has been reduced. Some of the spreads I've never really picked up. You look at your TED spread between the cost of funding for bank and treasury curve is near record low. So I think a lot of that stress is really, again, people reliving the traumatic memory of 2008, this almost passion that people have to try to be the next one to call the great financial crisis. And we've had all these economic Cassandras for years now predicting, this is it, this is a recession, the Fed is going to break things. And I'm not saying it's a nothing burger, right? I mean, there will be significant losses, especially if you look at commercial real estate. But my view is that it's going to be a process rather than an event. we have time. Like the average lease on a office building is about 5 years, so it's going to dribble through, but it's going to be over time.
And so do you think that we've seen the worst of it then? Like, do you think that from here we just grind back higher, or do you think like you talk about this process? Is it a process where we drip lower, or like how does that play manifest itself going forward?
But by dripping, do you mean stock prices or?
Yeah, well, I guess we should differentiate because we have to talk about stocks, we have to talk about the economy, and I guess to some extent it's different parts of the economy, right? It's not as easy as just saying this is going to be, affect the economy and we're going to have a recession. Like, let's just start with that, with the idea about the recession. I take it you don't agree with most folks who would argue, or sorry, I shouldn't say most, many folks who will argue that we had a drying up of credit from regional banks, and we're already having experienced the increase in the interest rates. The yield curves are inverted, and we're about to roll over in terms of the economy, and kind of 6 months from now we'll be well into the next recession. Like, how would you push back against someone who contends that's where we're headed?
Well, generally, I do not expect a recession in 2023. On the contraction of credit side, I would agree that that's happening, but that was happening before. I mean, if you look at Officer Lending Survey on the lending standard, I mean, that's been tightening way before the crisis. So I'm not sure that, on the margin, of course, it's a negative shock to growth. But we're coming from a pretty high level of growth. My view was that there was actually some sort of economic reacceleration happening in January because of Social Security cost of living adjustment. There was an increase in the tax bracket. Gasoline prices had come down. Wages were outpacing inflation. So it's hard for me to see. Basically, I think the economy is growing by 2-3% real with about 5-6% inflation. So we almost have double-digit growth. To go from there, nominally, to a recession in 6 months, I mean, that would be really unprecedented, or that would require a Lehman-like shock, so something that comes out of the blue, and it's not what I'm seeing. I mean, right now, if I look at the City Economic Surprise Index, it's positive in the US, it's very positive in China, it's positive in Europe, it's positive in big emerging markets. So I struggle to see how we get a massive deterioration in the next 6 months, especially since it seems that that regional banking crisis, it's serious, but it's contained.
Right.
And yes, to the question, like, how that will play out, I think it will play out at the local level, bank by bank. I mean, there are some banks that, do have extended CRE portfolios on which they will need to take losses, that have inadequate provisions. And then these guys will be taken out. I mean, we have a bank resolution mechanism. We have the FDIC, and more importantly, we have very deep-pocketed buyers who can pick up the assets. I mean, this is fantastic for the JP Morgan, Bank of America of this world. I mean, these guys earn $25 billion in net interest income every quarter. So there is quite a bit of money to go to scoop these little regional banks. And one might argue that, the U.S. was overbanked anyway, and the U.S. is not as reliant on banks when it comes to funding as Europe is. Like, if that crisis had happened in Europe, yes, bank credit is credit in Europe. This is not so much the case in the U.S.
Right. Can we go back to your comment that you said that we were in the midst of an economic uptick that started in January, and one of the reasons you mentioned was the social insurance kind of increase. Why don't you explain to people what you meant by that and how that's kind of playing out?
Right. So every year, Social Security, which handles pensions and disability in the US. So there's about 70 million people that are getting some social security check in the US.
Right.
They adjust the payments for inflation. It's called the cost of living adjustment, and that kicks in January. Now, because inflation was so high last year, the cost of living adjustment is maybe not the largest in history, because maybe in the late 70s we had high inflation, but it's certainly the highest in 40 years. It was somewhere around 8.5%, I believe.
Right.
So that's 70 million people that are getting an 8.5% pay raise.
Yeah.
At the same time, we had the IRS inflation adjusted its tax bracket. So one of the, depending which side you look at it, if you look at it from the government, it's great. From the taxpayer perspective, it's not great. But so one of the issues with inflation and taxes is that as you inflate the economy, people naturally switch into higher tax brackets. So typically tax collections outgrow nominal growth in high inflationary regimes.
Okay.
So to offset that, you need to reset the tax brackets. Usually we do that once a year. Now, last year, the adjustment was quite small. It was 3%. This year, we're getting the impact from the peak in inflation at 9% in June. So that adjustment was 7.5%. So the amount of money that got withheld from people's paycheck was a lot less because the tax brackets were adjusted higher. So that benefited the economy. We also had a pretty steady fall in gasoline prices. We had a general fall in inflation. Right now, we have less. Wage gains are outpacing inflation.
Right.
So we also had, lower 10-year yield went lower, mortgage rates went lower. So I think we had it's not huge, obviously. Generally, I think that the general trajectory of the economy is slowing, but we had a bit of a cyclical uptick in January. And remember, before we had the SVB stuff, people were talking about 6% Fed funds rate and the Fed going back to doing 50 or even 75 basis point hikes.
Right.
So that has not gone away.
Yeah. Well, I think almost you could argue that today's PMI is a kind of a clear sign that the economic bears continue to be surprised by the resiliency of the market.
Yes,
or the economy.
It's been going on for a long time. You look at the non-farm payroll, the jobs report. I think we had 12 misses in a row, all in the same direction every time the consensus was below the actual number. It's odd to me that people keep making the same mistake. Or usually, you think people would adjust, but the consensus has been systematically wrong. The bond pricing has been systematically wrong. We always talk about the dovish pivot, right? At 2%, at 3%, 4%, they were going to pivot. It's going to be next month, and it keeps being pushed back. And the inflation expectation, if you look at inflation swaps, they didn't see inflation coming. And every time we had these, all the big banks were coming up with these peak inflation reports and the view that, inflation would go back to 2% on its own. So it's been 3 years now that view has been wrong. So I think we need to kind of adjust for this excessively negative bias when it comes to economic growth in the job market.
Right. And then you have another, before we talk about what we're going to, how to play that and how to position yourself maybe for that, let's talk about how another effect that you think might cause the growth to continue longer than most people realize, and that being the continued spending of what is it called, the infrastructure bill, which is like what do they call the infrastructure bill? The Inflation
Reduction Act.
Yeah, which is like an oxymoron. Yeah.
It's Orwellian speak, the Ministry of Love for the Ministry of War.
Jumbo shrimp. And not only that, there's the money from there, and then there's also just the fact that a lot of these governments still had money that they hadn't spent before. Why don't you talk to us about your whole theory behind the continued spending from the fiscal side of of the government?
Yeah, so generally, I'm kind of a Kalecki guy. I don't think that the Kalecki equation, it's the view that for growth to happen, you need one sector to increase its balance sheet, because at the end of the day, everybody's cost is someone else's revenue and vice versa. So you can only have growth if somebody's expanding the balance sheet. And you look at the economy right now, and I mean, I'm bullish on consumption. I'm bullish on wages, but surely the household sector is decelerating. I think the growth is still good, but the impulse is only the second derivative is negative. Probably the same thing when it comes to corporations as earnings shrink. So that leaves really the government sector as the most likely to expand the balance sheet in 2023, 2024. And we see it both at the federal level and at the state level. I mean, at the federal level, we passed this massive bill in August last year, the Inflation Reduction Act, with about $250 billion, which, I mean, generally speaking, it's energy infrastructure. So it's the grid, it's green energy, it's windmill, it's solar panels. There is another $216 billion in tax credit for private investment. And these things are direct pay, meaning that you can claim the full amount, even if your tax liability is less than the credit. So, the money is going to flow through private actors, I guess my point. And then second to this, you have the CHIPS Act, which gave another $280 billion to fund basically fabs in the US. And you've seen all these big announcements by TSMC, Texas Instruments, Samsung, Micron, announcing massive fabs being built in Texas, Ohio, New Mexico, and places like that. And then keep in mind that these big projects, they take years to complete. So that was voted last year. The money will start to be spent, hopefully, in 2023, and then it will build out over the next 5 years. Like, there's no such thing as a shovel-ready government project. That's what we saw after the 2009 stimulus. Like, nothing was shovel-ready. So we appropriated the money, we earmarked it, we passed the bill. Now we need to spend it, and that's going to keep infusing the economy with cash. In the next 5 years. And then the second and perhaps more important dimension is the state level. So in the US, about 75% of infrastructure spending is done at the state level. Even the grid, for example, we don't have a centralized grid in the US, right? Every state runs its own grid. So if we're going to invest in upgrading electrical grids, that's going to be at the state level. Now, there's been a miracle for states. A wall of money has hit the states between 2021 and 2022. First, it was government grants to help fight the pandemic, which didn't have time to spend, and then it was a huge boom in tax collections. And the result is they had more money than they could spend. If you look at the balance of state general fund, there's about $590 billion that's just sitting there that they didn't have leftover money that they couldn't spend. I mean, California, for God's sake, the worst run state, I mean, probably Venezuela is somewhere between Venezuela and Haiti, the American continent, had $100 billion surplus last year. And of course, rule number one of politics is money needs to be spent, and rule number two of politics is money needs to be spent, especially in election year, which we'll have 2024. It so happens that two of the leading candidates are the governors of the largest state in the country, California, and the third largest state of the country, Florida. So we saw this massive budget announcement. I think in California it was almost a $400 billion budget. No, $308 billion budget for California. Florida, we see big pay increase to state employee, raising the minimum wage to $15, boosting teachers' pay. So that wall of money that came in 2021, 2022 is going to be spent over the next couple of years. And again, that's just the nature of the fiscal process in state, is that it takes longer because they cannot print money, right? So, or it's much harder for them to run a deficit. So, if they have a lot of money, they can't just print it right away, spend it right away, right? It's going to be over years. Infrastructure spending takes time. So I think that's what's going to pick up the slack in 2023. Now, of course, there is the the issue, especially in California, where states' budgets are very pro-cyclical. California is a flood or drought kind of state. When basically when the Nasdaq does well, the state has too much money. All the billionaires are spending because we tax capital gains very very heavily here. And then when the Nasdaq goes down, the state gets into a crisis. So there could be some retrenchment, but because we have so much accumulation from the boom years, we can just dip into the rainy day funds and the general balance. I mean, we can cover 30% of annual expense just between the existing balance and the rainy day fund. So even if tax receipts would stop, you could still cover 4 months of state spending. That's never been that high.
You know what I find interesting is that, 10 years ago, everyone was talking about how the infrastructure in the U.S. was so far behind and the airports stunk and all this things. And they would say, look at China, look at all their great shiny new things. Like, aren't we just doing what we always said that we should do?
Yeah, I believe so. I mean, we'll see, right? There's always this question of, how much gets done. I mean, California is famous for having this high speed railway between San Francisco and Los Angeles, which I'm sure you've taken, right? I think like they started working on it like 30 years ago, and now you can go to Fresno.
I took it on when I went, and then I took Elon's tunnel on the way back. So, but I do find it interesting. So now let's talk about what this means for the economy. Then,
right?
Is this spending enough that it forestalls any sort of recession? And in fact, could we have a situation where we're actually 6 months from now, we get you back on and we're booming?
I mean, that's not, the boom is not my base case. I think what we see is the economy keeps slowing but avoids a recession. But I would not rule out. Pardon me?
The fabled soft landing, or even not even a landing?
Yeah, and really through sheer luck. I'm not. The Fed. Yeah, the Fed might just get lucky. I think the economy is more resilient to higher interest rates than people think. I think there is maybe some segments of the economy that are actually boosted by higher interest rates, because that just means that the government is paying more money, more on its debt. So there's net transfer from the government sector to the private sector.
Okay, can you explain that? Because a lot of people have problems with that, and it seems counterintuitive. But just why don't you walk us through why that's the case? That actually higher interest rates could theoretically cause more economic activity.
I don't fully subscribe to it. Otherwise, Turkey would be the wealthiest country on earth. I mean, that's
okay.
That's the view of the Turkish central bank, right? If you want to stop inflation, you got to cut interest rates, and that hasn't worked all that great for them. But I mean, we can laugh about it, but I think there is some truth. I mean, it's basically the MMT argument, right? That the modern monetary theory argument that the national debt is the private sector savings account, basically, and as you increase the rate of return of that savings account, you operate a net transfer from the public sector to the private sector. I mean, one way to think about it is we have an 8 trillion balance sheet at the Fed, and the Fed is now paying close to 5% on that balance sheet. That's money that the Fed literally makes out of thin air to credit the reverse repo facility or put on the interest on deposits at the banks. So, I mean, 800 billion times 5%. I mean, if I'm not mistaken, that's 50 billion a year. 40 billion a year of interest payment that did not exist before.
Right.
Sorry, what am I saying? It's 8 trillion. Sorry, it's an
we got the wrong number.
Balance sheet. Oh, sorry,
right.
Yeah, with big numbers, it's difficult.
I know it's so. I can't tell you the number of times I've written something, Vincent, and I've mistaken trillions with billions. Like I put billions instead of trillions, and the guy's like, "No, you're off by a big figure." Three big figures.
Now that we have the right figure, 400 billion of interest. I mean, that's almost half of quantitative tightening, right? I mean, the Fed is shrinking the balance sheet by about 100 billion a month.
Right.
So you're shrinking on one end, but on the other hand, you're giving money away. Now that's money that either goes to the banks in net interest margin or gets paid directly to people as higher income on money market funds, CDs, and bills.
That's right. Like the way I think about it is if the government does deficit spending, that is stimulus, like that would be just
Yes.
like stimulus. And in essence, by raising rates, if you don't cut back on the amount of money that you are spending as a government, you keep it constant and yet raise rates, you're paying out more than you're increasing your deficit. Therefore, the private sector is credited from that. Now,
Yes.
obviously, the people will say, oh, but then it makes it harder to get a loan. So private sector credit creation goes down.
Yes.
But the real question is, does private sector's credit creation go down enough to offset the increase on the other side?
Correct. And at least all I would say is that there is an offsetting mechanism, that the impact of the tightening is not going to be as restrictive as people think because of the mechanism. And you can see the deficit, by the way. I mean, I think for the CBO came out for the first three months of the fiscal year, of the calendar year, it was running at 630 billion. I mean,
yeah,
that would be the deficit of a full year before COVID. We're doing that in 3 months. And that's literally money that's being credited from the TGA to Treasury General account to, private sector agents that's flowing into the economy.
Yeah, no, it's absolutely crazy, and then it's kind of shocking how everyone's so bearish,
Yes.
and how everyone thinks the economy is about to roll over. Why don't you talk a little bit about why you think that might be? What is, like, you mentioned the PTSD that everyone has from 2009. Right. Do you think it's that simple? It's just that this is what they saw last time, so they expect it to happen again, or is there more going on?
Yeah, there is some of that. I think there is also just almost a bearish bias, right? I mean, the bears always sound smarter than the bulls. You want to be the guy who called a recession, right? I mean, if my call is right, I mean, nobody's gonna call me back next year to congratulate me.
We will.
Oh, thank you. But yeah, because basically my call is meh, right? I think the economy slows, but it's not that bad, right? I mean, this is not, you want to be the guy who called, the big crash. And so that gets you more airtime, more views.
Do you think it's gotten worse in this social media world? And do you think that how we had increased polarization in terms of our news media? Do you think we have increased polarization on Wall Street?
We have radicalized economists. And,
do you think that's the case?
It could be. I've never really thought about it in these terms, but yeah, I mean, Twitter, the way FinTweet works is there's certainly in the same way that it rewards, engagement is higher on hot takes. Hot political takes. I mean, engagement is also higher if you say, "Oh, this is the Lehman moment," credit crunch is coming. I mean, if you just try to follow the data, which I try to do, like one thing I follow is tax collections. Like, yeah, it's consistent with that meh view. Yeah, it's slowing, but it's still pretty good. Like,
I saw in one of your reports that you mentioned that's one of your favorite indicators to watch. Why don't you tell people why that is, how you go about doing it, and how you interpret it?
Yeah. Well, the reason in general, I am skeptical of, big account, like big official BLS release, whether it be a, GDP or the non-farm payrolls. It's, I think Bismarck said that it was either about sausages or politics or both or diplomacy, but it was like basically, if you see how it's made, you don't want to eat it.
I didn't know that was a Bismarck quote. I didn't realize that.
Yeah, I think the Bismarck quote was something like diplomacy is like sausages. If you see how it's made, you don't want to eat it. So that's the quote.
It's actually laws. I looked it up. It's Otto von Bismarck. Laws are like sausages. It is best not to see them being made. I'll just tell a quick story. My first dog, when we had it, was a Rottweiler, and my mom named it Bismarck, and everyone accused her of using like her history degree and making the sophisticated dog name. So when the next one came along and we needed to name it, we named it Thumper. So it went from this political figure that what was he? He's
the Prussian chancellor.
There you go. You know way more than me, from the 19th century, to the Bambi character. Okay, so yeah, let's go back to
so going back to sausages. So so generally skeptical of the big GDP numbers and all that, especially skeptical of them now. If you look at a lot of the official statistics we have, the survey rates are very low. I think something is going inside the economy that is not being captured by statistics. Which one reason I think the market and the Fed is constantly behind the curve is I think the biggest growth in the economy is happening in the gig sector, right? It's people working as Uber drivers, as Instagram influencers, as OnlyFans creators, YouTube. If you ask like teenagers, I think 60% of teenagers say they want to become YouTube influencers.
Right.
It's fascinating. It's more than firefighters or whatever. So
I was worried you were going to say OnlyFans, but that's okay. I know.
that only works for a small fraction of the population.
That's
which
right. Okay.
I do not have.
I've got my OnlyFans feet page for those that are interested. You can see my feet for big money. Anyways, go on. So if you follow the actual,
so the point is, the economy, the statistics are kind of crappy in the best of time, and they are especially crappy now because of low response rate, because of changes in the way we work from COVID, and because the structural shift of the economy from, you no longer do your entire career at General Electric or General Motors. Most people, they take a year off, they go live in Mexico for a bit, they take a van or whatever, they sell stuff on the internet. So to me, the huge growth of the US economy is happening on the fringe, and that's not really captured by official statistics. One data set where it gets captured is the tax collection, right? Not 100% because people don't always declare, but with a big like Uber, Airbnb, like if you don't declare, they'll do it for you. So
right.
You cannot have to do it, right? So what I've seen, and one of the reasons why I've been so upbeat on growth when everybody was negative was I could see the tax collection just soaring. And this is the same thing I was describing about the state level. Like tax collections last year for state were 23% higher than people budgeted. There is this kind of hidden money-making machine. And you can see that in the federal tax collection, especially the individual income taxes, not the one that comes from primary income. That thing was doubling every 2 years. Part of that was capital gains, of course, which is reversing now. But now you get basically 15 to 20% of tax collection in the US come from people's income other than their primary job. So that's the part that's really growing, and that's the part that's not being captured in the official statistics. And after the SVB debacle, I immediately went to look at my tax collection data. Like, do we have any economic fallout here? Are we seeing, tax collection slow? And that hasn't been the case. Now, it's a very quirky data set, and I think that's the reason why a lot of economists don't like it.
Well, I was going to ask you, how often is it released? Is it a weekly, a monthly?
Every day. No, every day.
Every day.
You go to it's called daily Treasury statement. It's on the Treasury website. It's got a beautiful early internet interface.
Yeah. And so what you just look at it, like you compare it to last year, because I'm assuming there's some seasonality in it
now, right? Because tax day was April 17 today. This year I think it was April 15. So you have a lot of things that you need to pay attention to, and I think that's one of the reasons why people don't use that data as much as it deserves. The workday adjustment, when is Easter? Did Easter fall on you have some floating holidays, and it will make a difference, right? Because if 1 month you have 22 days versus 21 days, that's a 5% increase or decrease in tax collection, and it gets especially jumpy when people pay taxes. So you have to spend quite a bit of time just lining up the data correctly.
Okay.
Another thing you need to do, which is what I've done here, is adjust for bracket adjustment. So when I first look at the data, I'm like, oh my God, it's slowed a bit. It slowed a lot, right? Last year, tax collections were growing at about 12%,
right.
and that's kind of halved. So that looks bad on the face of it, but again, let me repeat, we had a 7% increase in tax brackets. So it's normal that government is collecting less money because everybody's paying a little less. Like if you adjust for the bracket creep, for the bracket adjustment,
right? I'm with you.
What we see is the economy is growing probably at 8-9% nominal, that's 5-6% inflation. And then you get another 2-3% real growth, which is pretty much where the Atlanta Fed, the GDP now estimate is. And again, if you have these numbers, how are we going to get a dovish pivot? Now they pushed it back. Of course, they always push it back. But as of a month ago, the view was this was it. We're done with rate hikes, and the Fed was going to start cutting in June.
Yeah. Now we got one more.
Yes,
it's always one more.
The same pattern. They keep pushing it back. It's like the second half rally. It's going to be better in the second half.
What in terms of this tax collection? I think this is a fascinating way of thinking about it. Have you gone back and looked at how it tracks GDP? Like, is it GDP that it tracks best? Like over the long haul? Like if you reverse engineer the numbers?
Yeah, I mean it's not perfect, but I would say screw it, like screw GDP. I mean, why do you need GDP if you can know how much if you can know people's income in real time? Like,
I guess that's
GDP,
true.
GDP is a messed up thing. I mean, imports is a negative, inventories, you can skew the data. You have all these adjustments, it's plugged, they take one number from one report, another one. I mean, I understand income. I don't understand GDP. Like, how do you measure my productivity?
Yeah.
Like what did I contribute to the economy today? I mean, is our conversation GDP increasing?
Of course it is. Of course it is.
I know what my income is. That I can see, and that will be consumption of goods and services. So I believe in tracking that, but tracking output in an economy that's 90% services, it's a fool's errand.
Yeah, it's kind of like the velocity of money always cracks me up when people talk about it like it's something that can actually be measured and seen, and I'm like, no, you realize that that's just a plug after the fact.
Yes.
Like, and it just cracks me up. Okay, so let's talk about this. We think that there's the economy is going to continue to be stubbornly strong. Do we agree on that, or at least stubbornly strong versus expectations? Yes. Right. But one of the problems is that the market continually keeps pricing the recession. As you mentioned, it was 3 months out, 6, for the past it's been 3 months out for the past year. And it ends up being difficult. Like I was talking to a hedge fund manager today, and he's like, I don't get it. He says, like, I don't know if we're ever going to accept like the pricing is always going to be 3 months out, or it's just around the corner. So the things that I'm betting on never materialize because the reality is the recession's always coming.
Yeah, that's my point. As long as everybody believes in it, it doesn't happen. There's almost a self-counseling prophecy here, where you can see it on the yield side, right? Because everybody believes a recession is coming. You have absurdly low, in my view, long-term yields, and that is quite stimulative. Like that means you can still borrow, tap the long end, and you'll find that means your mortgage rates are coming down. Especially since that's also the odd thing about these recessions. Everybody talks about recession, but you look at spreads and they're actually quite tight.
So I don't understand that at all. Like
it's a weird recession, right? It's a recession only where it's convenient. It's a recession. I mean, to me, it goes back to the idea that we're addicts. We're addict to rate cuts and easy money, and we are, the market is kind of like a baby throwing a tantrum, asking daddy for rate cuts, and almost trying to bully the Fed into doing its bidding by inverting the yield curve. And my guess is the Fed is not gonna be bullied by it, because as far as I can tell, the economy is fine, and we'll keep pushing it out.
Okay, so if that's the case, and we have a situation where for the next year, the Fed leaves rates here, and let's say the market continually thinks there's a recession for the next, the recession is only a couple months away for the next year. What do you think performs best? Like, how do you position a portfolio in this environment if you assume that we're never going to accept that the recession isn't right around the corner?
I was going to start with steepness, but let's not. This is a painful topic for both of us.
Well, yeah, that's right. But let's face it. If the market never accepts
Yes,
that
we'll never be right. Or
right.
maybe it will happen. It will happen in one night. Like one night, it will the 10-year will finally go to 5% where it should be, and then
yeah.
uh,
It's funny how you tell people, like the fact you even mentioned 5%, people lose their shit when you tell them that 10-year could be 5%. Like I look back in 2000 pre-GFC, like 5% was a regular rate.
yeah.
Okay,
Yeah,
but let's go back to my question though. So what do you trade?
I still think at some point we will have that.
So you believe that eventually the market will accept.
it will have it will have to happen. I just don't know when. And my view is going to be slowly and then all at once, right? The almost like you break a peg, right? It just goes. But I've been wrong on this one I've been wrong on this one for so long that I probably shouldn't be talking about it.
No, that hasn't stopped me for all the things I've been wrong on for so long. So let's talk about what might be the trigger. So like,
that would get me to what I think is the better play for this.
Okay.
Which I think would be oil. I think if we're right about avoiding a recession and the economy, not just in the U.S. by the way, but you look at the growth number of China was pretty good. People are talking about 5% plus growth in China. Europe is doing really well. It's kind of the uncelebrated hero.
Go look at the SX5E. It's almost on the highs.
Yeah,
I think your country's stock market, your original country stock market was hitting new highs the other day.
Yeah, it's mostly at this point, the French stock market is just handbags and jewelry, So, when the Chinese do well, that's it. It's the best.
Okay.
I mean, it's funny that the best China reopened play was actually Europe.
That is funny, actually, that everyone was busy focusing on buying China when they should have been buying Europe. And it's funny because everyone hated Europe. It just goes to show you, the more some things everyone's hated, it's like home builders. Everyone hates them, yet they keep going higher. Okay, so you think oil might be the way to play it?
Yeah, so basically you have all these positive economics. So U.S. economy doesn't fall into recession. China reopens, accelerates. Europe kind of stumbles through when it's carried away by the China reopening. The large emerging markets benefit from the weaker dollar because it's significant. I mean, whenever the dollar weakens, that eases global financial conditions. You start to see rate cuts. I mean, Brazil is an obvious candidate for rate cuts. So is Mexico, maybe Indonesia as well. So you have this kind of positive scenario, and amidst that, you have still a very tight oil market, right? I mean, basically, we have, we're missing 2 million barrels a day from Russia. I mean, some of that is probably exchange in the black market going to, through India and Iran, but, let's call it 2 million. That was offset by a reduction of Chinese demand by about 2 million barrels a day when we had the lockdowns. Now China has gone back online progressively, slower than people expected, I think.
Oh, really? Why do you say that? Why do you say that?
Well, I think there was this, almost perfect trade that a lot of my clients had on, and I was on board. Like in the winter, it was oh wow, new sanctions on Russia, and you no longer have SPR release, strategic petroleum release that was adding at sometimes 1 million barrel a day in supply from the SPR, plus China reopening, plus the winter. I think everybody, at least a lot of my clients who share my inflationary bias, were expected oil prices to go to 100 as China reopened, and that hasn't happened. I mean,
I see what you're saying. Okay,
it was basically the rug was pulled. If you look at the spec traders' net long position, it was massive going into December, January. Everybody was thinking, okay, it's going to go 80, 90, 100, and then it went the other way around, right, all the way down to 60. But in a way, that kind of washed out the longs. Now that what used to be a historically large net long position has become a historically large net short position. We still have like that fundamental case I still believe in it. I mean, the Russian oil is, is certainly there's less output there. You had the OPEC cut on top of that. China is reopening. Like maybe it's slower than it was. It's probably a little bit slower. The first thing that people did maybe was, go see their relative, neighboring city instead of maybe taking a plane to go to Europe. So Chinese, but you see all the data, like they stimulate construction sector again. They are, helping the real estate developers. So Chinese demand is going to come back. It's already coming back. And then you look at U.S. oil output. I mean, we're still way below where we were before COVID. I mean, I think there was one point, U.S. produced 13 million barrels. I'm not sure we can do that just because of the exhaustion of some of the fields in the Permian Basin. So rising demand, constrained supply, and that would be historically consistent with the fact that oil is a late cycle indicator. Remember in 2008, I mean the run to $150 on Brent was
right at the end. Yeah, it was right at the
something
end.
like that, right? July of 2008, right? I mean, at this point, like the U.S. economy was already in recession, or certainly slowing very rapidly, and still we had, I mean, because oil is a zero duration asset, right? It needs to be consumed right away. So oil doesn't really respond to like what's going to happen in 10 years or respond to what's happening in the spot market right now. So that's why it's so late in the cycle. So that would be kind of my view for the rest of the year. And that would be the wrecking ball for the Fed, right? Because and that's what could take markets lower, because if we see a run up in oil prices in the summer, then your disinflation process, the hope to magically go back to 2% that goes away, the hope of a dovish pivot goes away, and then that could be the trigger for our long suffering steepener trade when the bond market realizes, oh, holy crap, like the Fed will not be able to cut because inflation is heading back up, and I need to start pricing that the Fed funds rate is going to stay at 5% or above for a couple of years, and that could be this moment of horror that resets price almost immediately.
Do you think he has the stomach to increase it dramatic, like to walk it even higher? Like he's going to raise rates this next one.
Yeah.
But let's say that does occur and inflation ticks back up. And like, think about the damage that's being done to the Fed's balance sheet, to the government's balance sheet. It's the pressure on him is going to be enormous. Like I think he's going to slow walk the next rate hikes, and I think that's going to be really what's going to be the cause of our steepener working.
Right. Yeah. That's what I would do too. I think at the end of the day, the cost of going back to 2% is not worth the effort, and we can perfectly live with 3-4% inflation for a couple of years. Like it's not a
right. But what happens if you're right? The economy does better, oil's better, and right, all of a sudden he should be raising. He should be continued. Like the employment doesn't change, and then inflation, instead of going, it starts ticking back up. And right, what if, like, is he gonna go to 6? Is he gonna go to 7? Like, do you think he has the guts to do that?
I don't think so. I mean, we'll see that what we're describing is pretty much the 76, 77 scenario, right? Where, inflation, had a first spike of inflation in 1973. Then, we engineer a recession, get it back down to 4%. And then instead of going down to 2, it kind of came back higher. I think that's quite likely. And, an oil shock would get us there. Now, the reaction function then, I mean, it's going to be hard to tell. My impression is that, I kind of agree with you that we cannot, that the debt levels are so high that,
he's gonna, they're going to be screaming at him in Washington something fierce.
Yes, I think during an election year, or on top of that,
everyone thinks that he's like, I hear all the time he doesn't want to be Arthur Burns, he wants to be Volcker. I think that they forget how much Volcker was hated.
Yeah,
and they just forget that it was how hard it was to be Volcker. And I actually think that the next part, when the scary part occurs, when he doesn't raise rates
Right.
as quick, and the market gets scared the other way. Anyways, let's talk about what else might work in that scenario. So we have an economy that on the whole drifts back upwards. Oil works, maybe the steepener works. What else would you be looking at?
Going back to the short duration play, I think the front end of the curve remains interesting because you keep you compound at 5%, and you stay there, right? So you don't really need to buy a 5-year note when you can just roll over T-bills. I mean, obviously, if oil does well, energy companies are going to do well. There may be some benefit also in the really hated cyclical industrial names. If I'm right about this investment boom at the local level,
Okay.
You'll see a lot of demand for capex plays.
Meaning like this is for the infrastructure and the spending from there.
Yes.
Okay.
Yes. And then that would be also positive for emerging markets, right? I mean, we have this kind of weak dollar, higher growth scenarios, somewhat reminiscent of late 2000, 2005, 2007. That was a big run in many of the big emerging markets. You had weak dollar, fast growth, strong commodity prices.
And what emerging markets would you look at? Like, what countries would you like?
Well, I mean, I've generally liked Latin America. We talked about it every time I went on there. I mean, Brazil was a really star performer last year. It's been a bit more disappointing this year. You have some political risk interference. At least I tend to view that as noise more than
right. Okay. So Brazil could resume. What about Mexico?
Yeah, I mean, if oil, at the end of the day, if oil does well, I mean, Brazil is going to do well. I mean, regardless of the political situation. I mean, Indonesia has been a very very nice place to be, even on the fixed income side. I mean, basically, a lot of this is a pretty positive shock for a lot of EMs, because that they haven't gone along with the West and sanctioning Russia. So a lot of these EMs that used to pay the global price for oil or even higher are now getting oil or gas 20-30% cheaper in their own currency. That's for emerging markets, the biggest problem is always the balance of payment. That's the big constraint,
right?
And we just eased that.
Yeah.
So these are places that if anything, inflation is going down. I mean, you look at for the US, inflation at 6% is very high. For India, it's just another day.
Yeah.
And if anything, the inflation trends have been going down across Southeast Asia. Southeast Asia as a whole now has a lower inflation rate than Europe. So that tends to support consumption. That tends to support the local bond market. That tends to support the currency. So
it'd be fascinating if that was a trend that continued, and we saw inflation in the developed markets being higher than the emerging, or at least on a relative basis, like the change in inflation.
I mean that. Yeah, that would be my expectation. Yeah, that would be my expectation. I mean, I think the only path, or at least the least politically painful path for Europe and the US, is to accept that we're going to get 3 to 5% inflation for the next 5 years, and I would argue that is a good thing. There is nothing magical about that 2% target. And conversely, in a lot of emerging markets, because of demography, because of productivity, because of access to resources, I could see inflation continue its downtrend, especially as local bond markets get developed, as these countries are better able to deploy their domestic savings domestically. We could see a process where inflation splinters into two: higher in the developed world, lower in the emerging world.
I'm sure you saw Lagarde's comments the other day about changing the target. One of the things was that she was adamant that she has to hit 2% first, and then she would, talk about changing it. Almost feels to me like that's what they're going to do to maintain their credibility, is they're going to pull it down to 2%, hope for it gets there for 1 quarter, say bang, we hit it, and then change the target. What are you thinking from that perspective?
I certainly agree with the latter part. I don't even know if we need to hit 2% before we can do that.
I think they have to, though.
Yeah.
I don't know. Like why, you and I agree. Because they think that they're going to lose credibility, and therefore, if they go
because
to 3,
the credibility of Christine Lagarde is so pristine right now. I mean, she got what's left. These guys inflated the mortgage-backed market. They let inflation run to 10%. I mean, they completely misread the banking crisis. I mean,
I guess you're right, but in their minds, at least, they think that. When you go talk to clients throughout the world, I'm just wondering, like, what is the biggest surprise that you find? Meaning, like, what, like, that they, or what is their question that you get surprised at, that they're asking you the most?
Well, I mean, the last time. The last roadshows I've done were really dominated by this banking crisis situation. I think it really, wrong-footed, certainly among my client base, which is a lot of kind of Latin America, like hedge fund, family office in Brazil, and pension funds in Latin America. I think generally there is a pro-inflation bias because of this country's history. They see the sign. A lot of them were positioned very aggressively for this inflation trade. There's a pro-commodity bias there, and I mean, it worked fantastically well in 2022. Like a lot of the big Brazilian macro hedge funds were up, triple digit for the year.
Right.
And a lot of that went away in January, February. And then they have the impression that they got hit, I mean, it's weird, right? I mean, who would have expected that, basically treasuries, like the safest asset in the world, is the one that ended up causing all this chaos. So
no, it's funny, isn't it? I think it's hilarious that you stop the banks from doing risky things, and they still manage to screw up with the least risky asset. They managed to lose all sorts of money on it.
Yeah,
it's kind of shocking. Okay, so you're there, and so they're surprised at this, like, I guess, back up in the inflation trade. I get that. Were they shocked at that the banks were so stupid? Like, because I must admit, I'm a little shocked at that they somehow thought buying, long dated assets at 2% or 1.5% was going to ever make them any money, and this was a smart trade. Was that probably at least an element of their kind of feedback?
Yeah. I mean, I think the more than we can make fun of them. Like, you get SVB, they didn't hedge anything. It was a textbook stupidity. I mean, what really got them is the deposits moving out.
But the deposits only moved out because rates went up so much. If rates had stayed there, then nobody would have moved their assets out. It was kind of.
So by the way, if we keep pulling on that thread, I want to spend a bit of time on this idea. The ultimate responsible for this was this absurd notion of forward guidance at the Fed, and view that, because the Fed I'm not trying to excuse the stupidity of the people of Silicon Valley Bank, but it is true that in 2020, 2021, the Fed was kind of giving the green light, thumbs up to the banks. Hey, load up on that stuff, like buy some mortgage-backed debt, buy some long-term debt, because I'm going to keep rates at zero forever. Right. And I think that is an issue with forward guidance. And, as we're talking about Lagarde and credibility and all that stuff, maybe one lesson from this crisis is, we should be a little more humble about what we can predict. And with this forward guidance stuff, it was always stupid. Like, why do we need there's this trend towards central bank transparency, like the publishing the minutes, the summary of economic projection, and the dot plots. I mean, all that stuff we know is garbage. It doesn't work, but it fools people in a way.
Yeah.
I think it really does like more harm than good. And maybe one lesson we get from the crisis is a little bit more humility from central banks. We're like, hey, you know what? I have no idea where the economy is going to be in 6 months or 12 months, or where our star might be. And we go back to a, kind of more ad hoc, unpredictable monetary policy, which would work for a steepening trade. Basically, that would mean you need your term premium back. I think one reason we lost on our trade is because, why would you have a term premium when the central bank tells you, but the central bank doesn't know either.
Yeah, no, you're absolutely right there. It is funny. It kind of cracks me up because they'll listen to every word and price everything off of it and then say how stupid they all are. So it's kind of, and then the other thing that really cracks me up is the fact that if you go watch like the short-term interest rate traders, there was so many days when the Fed would come do their 50 basis points, 75 basis points, whatever it was, and the front end of the curve would be unched. There'd be nothing going on, and the stock guys would be losing their shit. And the stir guys are like, what are you talking about? You just don't know how to do this. And I think the problem is that the stir traders understood who to listen to, how the Fed works. So we have this situation where the stir guys they know what's going to happen, yet these equity traders are listening to all the various different Fed members and they're confused by it. They don't realize that you shouldn't listen to Bullard and you should ignore what he says, right? But they take him as being just as important as all the other ones. Anyway, so I'm completely with you that the central bank desire to chat is just absolutely insane. Like literally, what was there? Seven members spoke the other day, like yesterday,
and half of them contradicting the other half as well. I mean,
yeah. How is that helping it? Like really? And not only that,
I mean, I guess the goal is that they maintain the flexibility, right? Because if you send Bullard to do the hawk or the Daly to do the dog, like you keep, which I think is probably what Powell wants to do now. Like you have all these contradictory mixed economic signal. We don't know what the fallout is going to be from SVB, if at all. We have the debt ceiling situation. So really, you don't want to commit anyway.
Yeah, which is what they should be doing. So why not just shut up and say we don't know? Going back to your Otto von Bismarck, like nobody wants to see the sausage being made.
It's the urge to control everything. It's the clinging desire of the ego to control the present and the future and the pressure to you can't just be doing nothing, right? You have to come up, we're going to publish the FOMC meeting and we're going to do this improvement and we're going to communicate better and all that stuff. But that was all fluff, pump. And that didn't make us any smarter.
Yeah, you mentioned the debt ceiling. Do you have any views there?
Well, we need to solve that fairly quickly, obviously. I mean, I think it gets solved. I mean, it would be political suicide on the Republicans to block that. I don't think there's a constituency. Even in 2010, 11 already, I think it backfired for them when we did have, the Tea Party. Now there's no Tea Party. Other than a bunch of, grumpy congressmen and senators, no one really cares. I think that if the Republicans hold that up, it will backfire. So hopefully common sense will prevail. One thing that does worry me is the Treasury General Account balance is extraordinarily low,
right? Because
of debt ceiling, right? So we cannot issue new debt. So you basically empty the checking account. So for the government, the checking account is the what's called the Treasury General Account, which is the government checking account, the Fed. So usually they want to have about a month of spending there covered. They have like 2 weeks now. There's about 150 billion there. It's about the lowest it's been since late of 2021. And the reason I pay attention to that Treasury General Account is that there's almost this inverse relation between the TGA and the stock market. Basically, the rally topped out when the TGA hit bottom in December of 2021, we had to refill the TGA by almost $1 trillion, and that sucked in liquidity from every other asset class. That's, in my view, one of the drivers of the market meltdown last year. And then when we stopped refilling the TGA in the summer, that's when the market stabilized. But we are literally living on borrowed time. Like at some point, you're going to have to refill it. And then when that does that, I think that would be pretty bad for all of the liquidity
risk assets.
trades, like the Bitcoin, profitless growth, all the things that have kind of come back since last summer.
Do you think they understand how important that account is? The Federal Reserve. Do you think Yellen understands how much that it's affecting the economy?
I mean, maybe she does, maybe she doesn't, but I don't think that's something that it's out of their control to some extent, right? I mean, it's
well, it should not be though. Like in terms of the extremes, you're right; it's out of their control now because they've had to run it down. But there was times that there was many months in there, and like let's face it. Remember when Mnuchin ran it up to some monster number, and then they came and they emptied it. It's just it feels to me like they run it up and down a lot more than they should, and they don't understand that the consequences it's having, creating economic volatility. Anyways, that's just my 2 cents.
Do you think there's a political angle to it, like to tie in with the electoral cycle, or do you think it's just incompetence?
See, that would assume they're smarter than they are. I'm whenever someone tells me, oh, that the government's doing this great Machiavellian kind of theory to make themselves get reelected, I'm always like, these are the guys that don't understand anything. Like I don't. So I'd be shocked if they were timing it based upon the cycle. I think they don't understand how important it is. That's what I think. I think they they're just like, oh, okay, let's empty it, and oh no, let's put it back up, and they don't understand how much it's affecting the economy. That's my 2 cents. Okay, Vincent, it's always great chatting with you about the markets and learning all your great views. And I've got a little surprise for us here at the end. We're not going to talk about Emily en Paris, even though as much as I'd like to. What we're going to do is you are originally from Burgundy. Is that correct?
That is correct.
And you have moved to San Francisco. And you've been to San Francisco for the past, decade and a half. And what I thought I should do is make a little quiz for you. And I've got 5 questions about San Francisco and 5 questions about Burgundy.
Oh, wow.
And to see if you are which one you're going to do better with. Okay.
Just to announce before I make a fool of myself in public, this was not prepared. I am discovering the questions as we speak.
It's absolutely true. I did not even tell you we were doing this. I just said, well, we'll do something fun was what I told you. Okay, so here we go. And I'm going to actually have to say some things in French, which is going to be embarrassing. Okay, so the dishes, coq au vin, bœuf bourguignon, and then there was another one I'm not going to pronounce, which was basically eel stewed in wine sauce, couguère, and rigolette. Okay. How many of these have their roots in Burgundy cuisine?
I mean, certainly coq au vin and bœuf bourguignon. But the last one I did not understand. I'm going to blame your accent for it.
I'll spell it. Rigolettes.
Whoa, that is and you said it's an eel?
Yeah, eel stewed in wine sauce. So I can get you the proper name if you want.
Okay, I'm gonna go with 2. I'm gonna go with coq au vin and bœuf bourguignon.
Okay, so you got those 2 right. Those are the 2 Burgundy ones. But then the eel stewed in wine sauce is actually one of your Burgundy dishes. And the reason I think I didn't tell you is because I think it's named after a city. Burgundy dishes. Let me just grab it here and I'll tell you the name of it. The best traditional dishes from Burgundy, which eels just sounds nasty. But have you ever had it?
I've had it. It's once you go past the texture and the impression of eating a snake, it's actually, I mean, it's a fish, right? It's a white fish, so it's it can taste a little like it's a bottom feeder, so you need to get it from a place that's fairly clean.
Well, you know that we actually the Queen gets her eels from Ontario.
Oh wow, I did not know that.
Yeah,
Well,
she loves
who's queen? Whose queen are we
not
talking
your
about?
like well, kind of the Queen of England when she was. I don't know
one
what
who's
the
dead?
king. Yeah, the one that's dead. She used to go and get it. Anyways, I'm not sure the name of it. I lost it, but so it is all of them except the last one. So the Gougel, I don't Gougel,
Gougère,
Gour.
Gougère. Oh yeah, Gougère for sure. Gougère is from Burgundy.
Okay, and then the eels are from Burgundy, and then the Rigolette is actually from Nantes, Nantes. How do I say that?
Ah, okay. All right. Good.
So you were
All
close. I'm going to give you half a point there. You got most of it. Okay.
Yeah.
So when Jean Negon, I don't know how to spell his Naigeon, okay, made Dijon mustard in the 1750s, he added the following instead of vinegar in the usual mustard recipe. I'm going to give you a choice. Was it beer, milk, wine, unripened grape juice, or the sour tears of his competitor? So what did he replace vinegar
I mean,
with?
I'm hesitating between wine and what was
unripened grape juice. So like juice from grapes that weren't ripe.
I would go with that one, and my second guess would be the wine.
You're absolutely correct. Unripened grape juice is what he used. Okay, 1.5. Okay, so from 1337 to 1453, there was a 100-year war in France. They're not very good at math, obviously. But what surprising fact about Burgundy could most other regions not claim about their involvement towards the end of the war?
The fact that we're smarter than everybody else, playing the British against the French. We sold Joan of Arc to the British so that she could be burned. We had a prosperous court when you had Europe was starving and ravaged by the plague, and Dijon was a center of the arts and culture. We owned Flanders. We had some of the most beautiful painting, and we basically set the stage up for the Renaissance. So this is the golden age of the Duchy of Burgundy.
Well, and you also fought alongside the British.
Yeah, I mean, both ways. It depends. We're edging out best. Like we're trying to do what Macron is doing between the U.S. and China. Like be a little weasel and go where the wind is blowing.
Well, I'm going to give you full points there because you seem to know a lot about that. Okay, the final question about Burgundy. So what are we at? You had, we'll add up to after. Okay, what famous man from Burgundy was born in Dijon in 1832 and would go on to be especially famous in Paris and New York?
Gustave Eiffel.
Yeah, you're right. So why don't you explain to people why he was famous in both those?
Well, I mean, he was. I think he was a pretty smart guy. He was an engineer. This is the Industrial Revolution, and he set up a construction company in Paris and working with steel, which was the hot thing at the time. Started with bridges. He did a lot of really cool bridges. And then he won the bid for the 1900 Universal Exposition in Paris, which crown achievement was the Eiffel Tower, which was actually very cheap to build. Like if you look at the ROI on that baby, like really high. A lot of that white elephant spending, especially the Universal exhibition stuff. You build a huge thing and then it just goes to rust. Like Montreal is a good example. I think you still have like the cities dotted with remnants of the expo in Montreal. Well, the Eiffel Tower was, it probably paid itself over many, many, many times, including in from Emily in Paris.
Right. And then why did the New Yorkers like him too?
Oh, because we gave he did the Statue of Liberty.
There you go.
Yeah, that was a gift.
So you nailed that. I obviously did not make that hard enough. That was 4.5 points. So now we're going to do San Francisco. It's going to be tough to beat. You'd have to go 5 for 5 to beat it in terms of it. But let's see if you can do it. Golden Gate Park and Central Park are both extremely large. One of them is 778 acres, and the other is 1,017. Which is which?
I don't really do acres. I use a rational metric system. But I'm going to say the Golden Gate Park is bigger.
Do you know what the problem is? I didn't write this down, and you are absolutely correct. It is 20% larger than New York City, which I had no idea about. Like, that's fascinating. You're absolutely right. 1 for 1. Okay, here we go. San Francisco is only 47 square miles. Yeah. Oh, I don't do kilometers. I'm sorry. Because I found this in America. I would have given you kilometers, but yet home to over 800,000 residents. It ranks in the top 10 most densest U.S. city. What's its ranking? And actually, you know what? That's a little hard. I'm going to tell you. It's top 5.
I would think Manhattan is I mean, if we call it, if we go by the boroughs, well,
No, it won't be the boroughs. It'll be the city.
The city as a whole.
Yeah.
I mean, I still think New York is denser. Could there? LA is probably less dense for sure. What else could be? Chicago. You know what? I'm gonna go second.
You're awesome. Well done. Well done. It is second to New York City. Okay, so you're 2 for 2 so far. What famous fast food dessert was invented in San Francisco in the late 1890s?
Oh, the milkshake?
No, it was the fortune cookie. And it was invented by Makoto Hagiwara, who was a Japanese immigrant who invented the Chinese fortune cookie in San Francisco. Okay, let's see how you finish it up here. There is a famous prison out on the island in the bay called Alcatraz. What does that word mean in Spanish?
Could it be the fort? Maybe. Oh, no. It's the movie. Yeah, it's the same thing as the movie. The Rock.
No, it means pelican.
What?
Good try, though. That's what he said. I don't know. Someone maybe tell me that that's wrong. Alcatraz.
Nice.
Let me use Alcatraz in English. Let's just make sure. I found this. You know, it's one of the things about, it means pelican. Okay, the final question. What type of clothing that was invented in San Francisco during the gold rush? And then for bonus points, can you name the 2 inventors? And I'll actually give you 3 bonus points if you get the second inventor of it. One of them's easy to get. The second,
so I'm gonna go with the blue jeans, and I'm gonna go with Levi, Strauss, or whatever.
Yeah, okay, so you got 1 extra bonus point, so you're at 4. If you can come up with the second guy, you're gonna win with California, the San Francisco.
So I assume Levi Strauss is just one person. It's
That's
not 2?
correct. Yeah.
Damn it.
You'll never get it. I didn't even know there was two of them. If you don't know it, you don't know it. Jacob Davis.
Well, good for him, man. Good for him.
Well, not that good for him because Levi managed to get all the good stuff. So you ended up being 4 versus 4.5. That's about fitting. You should win in Burgundy since you are from there, but you did a great show for the San Francisco. Vincent, it's always a pleasure to have you on. Thank you for sharing your time and your views. We always love having you here. Why don't you tell people a little bit more about where they can find your stuff, where they might want to reach out if they want to talk to you about something, and how your whole shebang works.
All right, so I'm the director of global macro for StoneX. StoneX is a global financial service firm with Fortune 100 company. So the easiest way, if you're already a client of StoneX, we're very active in commodities, futures, ETFs, ADRs. Is just to ask your sales rep to get on my list or set up a call with me. If you are not a client, we've got you covered as well. If you go to my Twitter handle, Vincent Deluard, Vincent Deluard, the pin tweet, which I believe also refers to our market huddle on my inflation obsession that we did together, has a link to a sign up page where you can sign up for a free trial. You'll get 1 month free. Just DM me if you want another month free. I'll do that for you with pleasure. And then just reach out. Over Twitter. I've met some fantastic people on Twitter. I've been helped a lot. People have been very generous with their time, and I try to do the same thing. And I've noticed that, if you approach Twitter with the right mindset, meaning like not trying to be ridiculous and inflame people, it's actually a very nice community, and we get to learn from one another, and I get to learn a lot from questions that I get on Twitter. So always feel free to reach.
That's great. Well, thanks a lot, Vincent. I'm looking forward to chatting with you in the fall after a scorching hot economy for the next 6 months.
Damn it. And our steepener will be
That's
through
right.
the roof. And you're at 5%. We'll be heroes.
You know what? Actually, it'll be tough for us to be wrong because it's so inverted already. The real question is the forward steepener, which is actually already kind of steepened a lot on us. Will that end up being a positive trade? That's not as easy to say.
Yes.
All right. Anyway, thanks again, Vincent.
Thank you.
All right, Patrick, it's time for Talking Charts. What do you have for us?
Okay, let's, as always, start off with reviewing what were the top 3 things to watch 2 weeks ago. We were talking about the earnings, but while we were talking earnings, the real kind of pig in the python moment is still coming with all these tech earnings coming out next week, right? But generally, is there anything you're taking away from these earnings?
Well, apart from one big tech/car company, and some financials, most of the earnings have actually been beating. It's been surprising. Well, there was lots of people calling for this was the moment that the earnings finally showed that the economy was rolling over, and it's not happening.
Not yet, but it'll be interesting to see whether any of the fangs go down next week. Number 2, we were watching those inflation numbers, and I think they're just more of the same in a sense that we're seeing a reversion off of those highs, and it seems to be just coming in, especially as you calculate it year over year. So the real push was last summer, right? And so things have really slowed down there. What do you take away from the inflation numbers?
Well, you know me, I'm a big long-term inflation bull, but even I have to admit that inflation is, for all intents and purposes, back to 2%. If you look at the month-over-month numbers and average them over the last 6 months, we're basically there. And a lot of the things that we're just dealing with in terms of these year-over-year numbers are the increases from last year.
Exactly. And so as that kind of works itself off, the Fed may actually hit its target. Now, we'll see in the coming 3 to 6 months. And the last thing we were watching was crude oil with that OPEC gap. And, well, it did start off with a little bit of a follow through on the upside, but it's really been giving a little bit back. I want to talk about that chart, but has anything changed on your view on oil?
No, I'm still constructive. I think there's a lot of people that are playing it as a way to express their recession view, which I don't think is coming as quickly as they think.
All right. So the top 3 things to watch for the next 2 weeks. But next week, it starts off with the Bank of Japan monetary policy statement. Might be a more important one. What are you thinking there?
Well, this is definitely one where we might see a change in the YCC, although the market has become more subdued and not expecting that. It would seem to make sense to me to do a change the YCC while you're not stuck up against the upper band. Meaning that right now the 10-year Japanese JGB is not yielding 0.50. So why not expand it now instead of having it when it's a 0.50 and you're going to have everyone
points
shooting against it? So I don't know. I could see a surprise. I'm not expecting it, but it wouldn't. I would say the market's probably become a little complacent about that potential change there.
Do you think that would have an impact on the yen? Or not so much, or not as high conviction anyway.
I don't have as high conviction, and although longer term I'm very constructive about the yen and about Japan in general. You know, we saw Warren Buffett going there, and one of his big holdings, or 3 of his big holdings, are a series of different kind of conglomerates / trading houses that he's bought. I'm bullish Japan. I don't know about the day-to-day squiggles in terms of whether them getting rid of the YCC would cause everyone to just rush into the yen, and whether it's that easy. Longer term, I'm always a little skeptical about just kind of assuming that interest rate movements are going to move the currency. But having said that, you know, over the last year, when you look at the yen, you look at the 10-year, yield differential between the U.S. and Japan, it's been what's driving it. So maybe it really is that simple.
Yeah. So over the next 2 weeks, just as we get to the next episode, we're gonna that morning get the jobs numbers in the first week of May, and obviously the jobs numbers showed a little bit of weakness in the last go, but nothing that indicates that the next recession cycle has begun. Do you think that this jobs number, obviously it's going to be very closely watched, but you think that this is going to be an important one, or?
Well, yeah, it's important. I still think inflation is actually more important than the jobs, especially at this stage of the cycle, because I think that even if we get a little uptick in job unemployment, it's not going to be enough. But having said that, Patrick, when is the actual date of the jobs? Is it after the FOMC? I'm looking here. The FOMC.
Yes, it is. It's the Friday. It's the
Right.
Friday, the 5th.
So we have the Fed on Wednesday.
Yeah,
May
so I'll
3rd.
just make number one was the FOMC.
Oh, I'm
so we
running
could-
ahead. Sorry. I
Yeah,
guess
you're
I
running
should have
ahead, but
paid attention.
but
You should have paid attention when you told me what the top three.
Yeah.
were.
So, but let's talk about them together then. Like, obviously, all eyes are going to be on the fact that there's a rate hike coming, right? And at least the market continues to price that.
Well, and we saw today. We're taping this on the Friday at lunch, and we saw the PMIs come in this morning. They were smoking, and that was surprising. A lot of people thought the economy was rolling over. It's certainly showing stubbornness, and in fact, has reaccelerated a little bit in this last month, which was really not something people were expecting, given all the angst in the regional banks and the fact that they see credit contracting. So I think it'll be very difficult for the Fed to not raise rates because it's coming May 3rd. Right now, I think that's 90% is priced in.
It's 88%. I'm showing it on the screen here. It's
the Fed has never in modern history not raised rates when that much has been priced in.
Yeah.
So
they get that stage they give the market what they expect.
Right. So we're gonna have one more.
But is that the last one in your mind?
I don't know.
There's still some probability on here for the June meeting to have a hike, but not very much. It's almost a 30% chance. So I guess it's a wait and see, right?
I can tell you one thing. It's been easy to say that's the last one, and I know that some really smart friends of mine that are plied their wares in trading short-term interest rates and bonds. They've been saying that it was the last one. They said it a couple of meetings ago. They said it last meeting. And now I think they're going to say it this meeting. It's kind of like going out drinking with you late at night. That's the last beer. That's the last beer. That's what I feel like with them. I'm tempted to say that I really do think there's a good chance that they pause on this one. And if they
but do
don't,
they tell?
they
but
should.
do you think that the language implies that, or do you think that they just wait to see how things play out before they advertise that?
I think they wait and they don't commit to, they don't pre-commit to pausing. At least that's what I would be doing. I would be not committing to
that gives you optionality, right? Like it just
why give it away? If all of a sudden, plus. If you're worried about the financial conditions loosening, the last thing you need to do is increase the chances of the kind of stock market taking off by saying no, we're done.
Yeah.
Anyway, so that's
all right.
the way
Well,
I
let's
look
talk.
at it. So back to the jobs numbers. So I think the jobs numbers are going to be interesting because they're going to be after the FOMC.
Yeah.
So it really will be a case that if we get a situation where they go one last time and then the job numbers tick up, then that will cause the narrative that's the last hike probably will be cemented from that.
Right. So let's talk some charts here, buddy. Want to start off with the S&P 500, and while there's no dispute that the bulls still very much command this trend in a sense that higher highs, higher lows, volatility is low above all of its moving averages. Like anyone speculating that the market is turned already is doing so just on intuition. There just is no technical evidence of a turn. But what I thought was really interesting was just the actual lack of bullish momentum and breadth in this market. Because while I've been regularly talking about us making it all the way to the the 4,300 area. The one thing that I generally like to adhere to is that in most cases in the S&P, a lot of major bull impulses tend to last in the 4 to 8 week window. There's a usual length of duration of impulses higher, and really, if the market was going to make it to 4,300, I would have wanted to see it already underway, in a sense that the bulls are cracking it higher, and yet the last week and a half, the bulls have really made no progress to break out above that February high, and that's really starting to create divergent momentum. And like the one thing in this type of environment, the one thing the bulls need is momentum, and they're not getting it. And even though you're talking about some of these earnings coming in with beats, it's really not a broad market rally at all. Those FANG stocks, like there's like those 10 stocks that are doing the majority of the work in terms of pushing these indices higher. You're not seeing small caps participating. It seems like I don't see a reason to get bearish now, but this is not a vote of confidence for the bulls in terms of what they're accomplishing. What's your thinking on that?
Well, I've recently kind of gone into the Jimmy Jude camp, where he's highlighted the fact that there's going to be so many buy stops up above here, folks that are sitting here and are trading against this upper top of the range. And he said, yeah, we might go down. I think he said something like, in typical Jimmy Jude style, we're we might go down, but not before we go and run all these stops first. He said it a lot more colorfully than I did.
But you know what? I agree with that, because first of all, it's going to take a lot of technical damage to turn this trend. I mean, we have to pretty much make it even below 4,000 on this S&P before there's real technical damage. I mean, a quick even 50 or 60 S&P point drop here that is immediately bought on dip could see, you know what? Actually, the November-December price action might actually be, not that it's going to follow this analog perfectly, but it might actually demonstrate the type of thing that we might see. We right now are experiencing this low volatility, low daily range. The VIX is down to like the 16 handle, but suddenly, we get a quick drop in the market that's 100 plus S&P points, and then that Jimmy Jude rip. Right? Like that rip to the upside makes a higher high, just jams all those stop losses that are sitting above there. Maybe we make it to 4,250, maybe even 4,300, where the August highs are. Those are all scenarios that I definitely not opposed to thinking can happen. The one thing I don't think is going to happen is that this market just going to crash right away. Like even though I'm bearishly inclined and think that there's something later in the year that can emerge, I'm really not a big fan of this market just starting to dump on the downside in this window of like the next couple weeks or month. I think that that's something reserved for a little bit later in the year on that front. Any last comment?
I just look at sentiment, and sentiment to me is still, when you go look at the Bank of America, the FMS survey or whatever it's called, you'll see that people are already priced for a risk-off event. They're priced for a recession. They're expecting things to roll over. And I think that markets confound, and it's never that easy. So it wouldn't surprise me at all if we get a push even higher than you're saying. You're saying 4,300. I could see us even going higher. And people actually getting pulled up. And
I think you're almost like, I would push back and say other things. Like, for instance, most of the CTAs are being forced long this market on the upper boundary. There's you
CTAs,
take things like
trade.
They're just
but
even
but
like the low but with
money,
VIX as low as it is, you've got the vol targeting funds probably long more than they should.
I actually disagree. I was looking at the vol targeting things the other day. They're still, although it's been increasing, they're still much lower than they had been earlier.
Yeah,
we're both in the same camp. The real question is, how much of a rally is it, and how much do they squeeze the shorts? is
Yeah.
what we're arguing about. And I think we could squeeze them more than you think. And I suspect by the time you want to sell it,
You won't want to.
by the time you should sell it, you won't want to.
That's the I love it. Anyway, I'm not going to say any more. All right. Interesting. I wanted to just touch on the dollar. Of course, we had to. I almost wanted to put it in the top 3, and I was
know,
like,
you can't be doing that. It's always there.
It's always there. It's always number 1. But in my heart, it's number 1. It's like a child to me.
Well, you have a favorite, do you?
You have a favorite. With the dollar index, it retested that February low, and I know that there's a lot of bears out there on the dollar. While I'm not convinced of a huge bull leg higher, I actually think that the currency might be going into the summer in far more of a range-bound price action than a downwards bear phase. And at this stage, if we see that this retest of the lows, even if it does the turtle head formation and pops down to 100 very temporarily, I still suspect coming to the top of range 104, 105, then trading back down, and we find ourselves somewhere in the summer, and the dollar will not be far from where it is today. I just think that it's likely going to trend far less when a recession hits or other things like this, and then we could really see currency movements. I just don't think it's imminent.
Well, I'm not going to disagree with that. I will tell you that my favorite currency whisperer has been giving me tidbits that he thinks it's headed higher. So he's in your camp.
Yeah, but
I've learned not to fade the currency whisperer.
Okay, then I'm going to just shut up and say nothing else. No goochering. Okay, so let's go on to our favorite non-fiat currency, gold. And we have to settle this one up in a little bit.
Yeah, but, should we just save this all for the bet, or did you want to talk about it now?
No, I just want to talk about the chart. Generally, to me, I am very, very bullish gold. I just am very bullish gold at the stage where there's a true easing happening in the monetary cycle. And we can argue as to when that will be and what will trigger it. But, everyone on the way up wanted to say that, central banks are buying and all this stuff that you spews out of your mouth. But I think that gold, there's a lot of bandwagon hoppers that got in. I'm not opposed to seeing gold wash out the weak hands. Like, I think that there could be a throwback here. And
I'm going to push back hard against this. I feel like that there's no bandwagon hoppers. I think that if you go look at gold, how far are we from an all-time high?
Right now,
we're
$100.
Okay, so whatever. It's nothing, right? Like, if you picked another asset and told me it was within a hair's breadth of the all-time high, the people would be foaming at their mouths bullish. And yet here we are with this thing behaving like everybody else. Like, go look at the stock market. It's well off the highs. Go look at the bond market. It's well off the highs. Yet this is an asset that is just, $100 from its highs. And yet everybody hates it.
Do you want to? Do we go back and rebet on gold again? I feel like
I don't know. No. Because I got to tell you something. I got a huge flack from my
it was mispriced.
Diehard gold bugs that told me that I goochered it, and I'm not arguing. So I'm refusing to bet. I refuse to bet on gold again and goocher it.
My view right here. If we did a one-touch bet, that I would take the bet that we would touch 1900 before we'll touch the all-time new high.
Okay, I'm not going to say anything. I don't want to.
You don't want to gooch or anything.
I will tell the folks that were giving me, rightfully so, saying a hard time, saying that I goochered it. The reality is that the bet expires, and I do have a good habit of having to be right on my bets just kind of the day after they expire.
Yeah, absolutely. No, you're always early. You're always early.
So it could be just by letting this expire, letting my option expire out of the money, it's now going to go into the money, hopefully.
All right.
And I like your skepticism. You're just one of many. Like,
I haven't sold my gold.
No,
I just basically think
you're like a true a true.
I'm a
gold
trader.
bug. Well, you're a true gold bug in that you're like you expect it to hurt you, but you're still long.
I just hedged the shit out of it, so the theta's going to hurt me. That's about it.
Okay.
Anyway,
What else you got?
let's talk crude oil and this pullback, and really, what I was looking to see is whether that 82, 83 level where all of these kind of highs were coming in was going to be able to be beat. And it was kind of like a sneaky little one-day prairie dog. It just kind of poked a little above it and faded right away. To me, crude oil's in this trade range. What's interesting is that as it gap fills here, I don't think we see crude oil back at 65. And so, therefore, if I don't think we're going all the way back to 65, then that means as we approach the bottom of this range, the question is it the buy on dip? And will it give a great entry like at 75? I'm going to watch that very closely. I was hoping that it was just going to rip to 90, but this pullback might actually offer a really nice tactical reset to apply a new long trade if it gives a good spot to enter.
I'm long. I'm staying long. I'm trying
Right.
to. I think it's headed higher, and
Right.
It's again. I think that this is people putting on the recession trade.
So what I want to talk about is nat gas. Now, the thing is that nat gas is stuck at the bottom. I'm curious that going into the summer, does it end up just trading the same way as lumber? Like, when was the last time you looked at the lumber chart? But it like.
I actually looked at the lumber chart the other day, and I got to tell you this story. So I have a good friend who's building a house, and he's telling me, you know what, I'm building this house, and I don't really know what's, I don't have a lot of things going on in the market except for, and he lists a couple of his kind of long-term positions, and he says, and then lumber, I've hedged my lumber. God. He's literally this guy. He's bought his lumber futures, and he's like laughing. He's saying like, I think there's 6 of us trading it. There's no one. He's like talking about how illiquid it is, and there's only one contract now that there's listed. You can only see the front month. This thing it barely trades. Like you have these people that use this as like a sign, and they have it all into their huge macroeconomic models. This is a tiny little market that if someone wanted to move it around, they could move it around tomorrow.
It's crazy. But no, you know what's interesting about lumber is how divergent it is from your favorite little trade, the home builders. Like, talk about home builders running. Did you when you say, "Oh God,"
was it, like I gave up on it, and I was like, you know what? I listened to all the doom guys telling me that interest rates is going to kill it, and
I don't get this trade. I don't get it. Like,
because
no, but look,
the economy is not as bad as everyone thinks it is. Is the long and short
but
of
still, it still costs money to finance these mortgages at these higher prices. It's like
there's a huge amount of millennials that are moving out and buying houses. It's going to overwhelm them.
I feel that as this thing finishes whatever run it has, and I don't even think it might be this week or next week, it might be a month from now, but when this thing does something ridiculous, like go back to its 2021 highs, I'm going to short this piece of shit, and I'm going to look at it as a gift.
I'm going to push back and say that your experience in 2008 and 9,
that's not what I'm looking for.
No, it's true though.
I'm not looking for.
But you're judging it as a piece of shit. If I showed you this chart,
for a second.
If I showed you this chart and I didn't tell you the symbol, you'd be like, "Holy shit, that thing looks great."
Of course, it looks great. That's why I'm not shorting it. But
I get it. But you want it. But instead of being long it and going, "This thing looks great. I want to be long it." You're saying, "I can't wait for this to go up more so I can short this piece of shit." There's a judgment in there. You go talk to your therapist about that.
So
there's a judgment in there.
I'm going to talk to my therapist, but let me ask you one thing, all right? Why is it that car companies like General Motors are down along their lows, or Ford right along their lows, or Tesla is rolling over? Why? Because you raise interest rates and people start defaulting on the car loans. The total amount of cars being purchased goes down. This is killing the car industry. What? And everyone's got money to buy a freaking house? How do you square that peg? Well, I don't even know the saying. I'm going to make fun of myself.
The car company's a stupider business. There's a lot more competition. They go and they do dumb things, and they all compete and drive rates. They drive margins down to zero.
I feel that you are literally it's being bullish to home builders is the same as being bullish these car things, because they are the interest rate sensitive and they are economically sensitive. And this idea,
I am sure someone a lot smarter than either you or I will write in or tweet it and tell us why they're different.
Oh, I'd love to hear the story. Anyone who wants to educate me, I'm all for it. Anyway,
by the way, that board, like that looks like a 1, 2, 3, 4, 5.
Yeah,
a quintuple bottom.
It's not going to hold.
It's definitely not.
I'll be quite seriously, I will short Ford way before I'll short the home builders. I just think it's ridiculous that the home builders are doing that. But the home builders are far from being a short. They, in fact, technically, like you exactly observed, it really does look like the home builders are going higher. I'm not going to short this kind of like strength. It's one of the strongest sectors. It's ridiculous.
And nobody owns it. Nobody's talking about it. No, I shouldn't say nobody, but few own it, few talking about it.
Well, I think that a lot of people are just chasing momentum. If you're like filtering by the strongest sectors, the home builders are going to be at the top of the list now. Next to the NASDAQ stocks. Anyway,
I got scared off by the Doom at 11 crew, and I shouldn't have. All right, what else you got?
Just last thing I want to touch on, and then we'll move on, is just the 10-year bond. And, with inflation coming in, I know you hate bonds. You have only 2 states. Those listeners that are newer, Kevin only has 2 states. Either he's neutral bonds or he's short bonds. There's no such thing as Kevin being
even
long
neutral,
bonds.
That's really almost a long, and just like slightly short would be almost a neutral.
Yeah, exactly.
Like flat would be a long.
But the thing is that if we are, okay, let's not even call it a recession. We have an economic slowdown.
Okay.
And you have inflation, like you were saying, month over month, you're almost back to the 2% levels. If so, inflation's coming back in and the economy is slowing. I just don't see the environment where bonds make lower lows in this stage. Like if you're going 2024, 25, you can be all bearish bonds all you want, and maybe you'll be right. But I think bonds do not make lower lows this year, and I think that this is some sort of a bottoming formation on the short term that may lead to months of counter trend rallying. Maybe it might even look like a home builder chart. Just won't make sense to you.
Well, no, wait. Are you talking lower lows in terms of yields? Or are you talking
bonds?
Lower lows
the bonds, which would be yields higher. I just don't. I don't think yields are going higher.
There's no way yields are going higher. You think bonds are
not? I would think that the bond bottom and the yield tops are in for this calendar year. Whether in 2024 there's another leg of like another inflation surge, another breakdown in bonds. As a trader, I'm totally open to that happening. I just think the bottom is in for the year.
So what would you, if you were talking the high in the 10-year was 433?
Oh, we're talking yields here?
Yeah, yield.
Okay.
What would you give me for a one touch for the rest of the year? Like what odds would you give me?
Okay, I'll tell you what. How about this? You let me sit on that, and maybe we'll make some sort of a bet in the next show.
Okay.
Because you will, eh?
Depending on I'm assuming you got to give me proper odds, but like you got to price it right. You can't just go.
Okay, well, can't you throw it into the Bloomberg and do some sort of your magic?
I don't want to start teaching you how to that I actually price out these one touches that we do.
Anyway, I'm not like an ultra. I'm not an
Mm-hmm.
ultra bond bull. I just don't think. I think the yields.
Okay.
These are the highs of the year.
Can I give you
and we could see even
pushback?
3%.
Can I give you a pushback on this?
Yes, please.
Okay. So do you agree that after the 2008-9 crisis that something changed?
Mm-hmm.
Like that we went through an abnormal period in the market? Right? I think what happened was we tried pulling back on fiscal and doing more monetary, and we actually created this environment of zero interest rates. Now, if you assume we're not going back to that, if you think we're going back to that, you're going to be absolutely correct. So if you're in the camp that we're going back to post 2009 environment, then I have nothing to say. It's just a question of, you place your bets and you take your chances.
Okay.
I don't think we're going back to that because I think that the world has changed for a variety of different reasons. Then if you go back and you look at the 10-year from before 2000, let's say 2007, prior to that, the range was like the lowest it got in 03 was 320, and it spent most of its time at 450 to 5. And there was lots of periods in the 90s when it was 7, 6, 7, 8. And I'm not trying to say that we deserve to be where we were in the 90s, because that was a much different situation, because we were coming off of the 1980s or late 70s, early 80s inflation. But I don't know. It still feels to me like too many people think we're going back.
You know what?
This 2009 to 2020 period. And I guess I just push back on that and say, I think something changed. And I think that we're in a new environment. And I could easily see a situation where the 10s are trading 4.5.
So you know what? I feel like this is a deja vu of the bull bear debate we had in 2019 in Chicago at the Trader Expo. And the thing is in the end, you were right. And my whole argument was what? That you were way too early. And I actually don't think you're going to be wrong. But I still think I'm going to be right about the fact that that the rest of this year is going to we're going to see the tops. Like
listen, I could be. You're right.
Like you. The problem with you is you are such a big macro thinker that you come up with these stories that may be a great story for a 5 to 10 year time frame, but then you're trying to trade it on a month in, month out basis. It's like, well, I'm not accusing you of that. I don't know what you're doing, but like I just don't see the environment where yields this year are going to higher highs. And I'll make you a bet next show.
Okay. I will say this though: very few people thought we would even be here. All the way up in terms of yield, people were like, no, this is it. This is it. Oh my God, you can get 2% on a 10-year. We haven't seen this in ages. Oh my God, you can get 2.5. Like, it's been the whole way.
Yeah.
And listen, we're probably due for your call on the dollar of it just being a boring range bound summer. It could be that that's the call on all assets, that we are going to be frustrating people.
The next 4 months, 100%. Like, I mean,
I've been arguing this for a while, that this year, I said to you, this year is going to be the year that frustrates both the bulls and the bears in the stock market. And if you want to extend that to a lot of different markets, I'm not going to push back. And you're probably correct.
And you know what? It almost makes sense, because ultimately, just like the point you made earlier, I think the market needs to frustrate the shit out of most people, that almost nobody will have the conviction to hold the core positions they should, just because they're mentally exhausted from trying to press trades that haven't worked for months, and their conviction will wane, and that's when the big moves will happen.
Okay, from your lips to God's ears.
All right. Anyway, that's enough for talking charts. Let's go on, because I want to talk about skin in the game.
So I lost.
Yeah.
And like I like in the Star Wars, when Obi-Wan all of a sudden feels something in the Force.
Disturbance in the Force.
There's a disturbance, and the millions of voices just cried out all at once. That was the 7 gold bugs that actually listen to our show that were like, oh my God, Kev just bet positive on gold. He just goochered it. I apologize for that, folks. Patrick offered me some tempting odds, and I took them. I still think it was the right bet.
No, I'm sorry. The reason I have now the lead, by the way, how long has it been since I had the lead?
It's been a while.
It's been a while, and I just took you, and I made the comeback very easily. All I did was take your emotional biases to your trades, and I just force you to take those trades.
You also sold me volatility, which you've never done.
Well, there you go. You're welcome.
That was a very unusual move for Patrick. Usually Patrick's the buyer of volatility. Usually I'm the one offering those up, and he put it out there, and I couldn't resist. Okay, let me so just the long and short of it is I bet that we would get new highs in gold And what did you give me 2-1 odds? And I lost. How was I close? By the way, how far was I?
You were far.
Was I?
Like,
Are you sure?
well, okay. I mean, what actually, it's true. You actually did get close because
the high of gold in the first week.
Yeah, the high of gold was 2063. So you were actually within $20.
Yeah. So like, and I had a one touch.
Yeah, well, you were
So
within
I still
20.
think
It was.
Yeah,
You're-
so I was
you're-
within
you
20
could- you were
bucks.
close.
Like, it's 1%. I still think it was the right bet for me to take, but I am sorry that I got treated. All right, let me tell people about Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager. The other guy chooses which side of the bet he wants. Each wager needs to sell by next episode. We're going to play up to 50 points, and at that point, we're going to take out 3 lucky, or depending on how you define it, unlucky listeners that we can quiz them about why they made so many stupid bets. Okay, Patrick, what do you got for me this week?
You know what? I actually don't know if I have. You know what? I want to bet on volatility, but I don't know how to structure this trade. Like, because it's too simple to do an over under because you would take the over. It's just such low volatility. But I mean, how would we put a bet about volatility?
Well, you could look at the like forward VIX curve first of all.
Yeah, we could, but like let's just look at this and simply my idea is how do we make a bet about whether volatility comes back into that trade range from earlier in the year in the 19 to 20 range up here, 1921. Like I think that it'd be an interesting bet as to whether volatility.
We could do the average over the next 2 weeks.
Well, okay.
Every day's closed divided by 10.
Okay. But then what would be a fair kind of
you got to pick
over-under?
a little bit. Yeah. So what you put it
what
out there.
do you say?
You pick your spot. You got to pick something you think that I will be
The average, eh? No, because like 18 is almost too low. I feel like you would. I mean, it's not low enough. Fuck it. Let's do 18. Is the average volatility on the VIX, the average of the 10 trading sessions between now and the next show, going to average above or below 18? And we'll do a straight up bet. You know, you almost have to take the under, right? How do we?
Jerry is trying to talk me into the under. I was hoping
okay. No. Let's do it straight up. I'm going to give you a chance. I'm not going to bet big on this, so I'm good with it. I make a mess of this. I'm making a fool of myself. Let's just do it. 18 average. The average VIX level.
I'll take under.
Okay.
You know what?
I don't want to
can't call myself an index trader if I'm not short vol index vol.
So we're 2 points apart. I'm not going more than 2 points. I'm going to give you a chance to tie it.
Okay, that's fine. 2 points it is.
All right. So it's the VIX, the average price
of the
above
cash
or below
index
18
over the starting on Monday.
I get 18 though, so an 18 even is mine. 18, so it's 17.
Okay,
you're 17.99.
You're like a dealer. Is that right? Who wins in a push? Does the dealer
of course
win?
the house. Of course the house.
Okay.
All right. Anyway, we have a shorter format this week. We'll be back to our normal format next week. So thanks for joining us. Kevin, you want to do in the exit?
Yeah, so thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter at the Market Huddle. Lena's there and she gets tired of talking to Patrick and myself. You can listen to Market Huddle on all the networks. You know the drill. Patrick, where can they find you?
You can find me at bigpicturetrading.com and follow me on Twitter at Patrick Serezna. And where can they find you, Kev?
You can go check out my website, themacrotourist.com. And if you want to join us in their chat, you can go to themacrotourist.com/chat and come join us. It's a great group of folks in there, and more the merrier. So
maybe I got to come out one time and say hello in that chat.
You should do that.
Okay.
You should. And listen, you can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So now stick around for the little after show.
Yeah. Little after show because, well, we just need to rate this beer.
Yeah, well, listen, a
and-
big thanks again. And I realize that we might be getting the Bank of America Delta One desk in trouble for sponsoring. They didn't really sponsor anything. And
No,
it was-
all they did was they offered to
is
send us a
listening,
great tasting beer
That's right.
that they
It
wanted
was-
to share with us.
Yeah.
So Daniel, thanks for sending this in. So you know what? I'm generally a fan of IPAs, but this is I like it. It's that tropical fruitiness to it is what I usually like in a nice IPA. I'm gonna give this an 8.1, bud.
All right, so I had something slightly different. I had the Hakala hazy golden. Ale.
Okay, so we only disclose now that you're drinking another beer.
Because well, no, it was the same
Yeah.
company. It was Mount Holly beer, but yeah, I think unless I was wrong, we got 4 different versions. So anyways, I'm drinking this.
Okay.
I actually really like it. I'm going to give it a higher rating than you. I'm giving it an 8.9.
Oh wow! That's a
what?
high score.
That's
I like it.
Lena, admit that 8.9 is not a like. 8.9 is I love
like it a lot.
and I'm
It's good.
going to
That's
order
one of the
a
highest
case.
scores that you've given a beer.
Yeah.
I think, in a long
Yeah.
That's
time.
insane, dude.
It's
Oh.
well,
You really
maybe it's
like
the
this
lunch
one.
beer. Maybe I like lunch beers more than I think. It's also from Vermont. I feel akin to the Vermont.
Oh, there you go.
You know, like they do maple syrup. They're a little left leaning. They're like us. It's true.
All
Isn't
right.
Bernie Sanders from Vermont? I think he is.
It's
Oh,
entirely
I think
possible.
so,
Yeah, I'm pretty sure he is. It's a lovely state. It's terrific. And what's funny is that
and
they're
clearly
left-leaning
and clearly they have good beer.
yeah. And what's funny is that they're left leaning, and then right beside them is New Hampshire, and their slogan is literally "Live free or die," and they got like no helmet laws. I'm pretty sure you go there and like guys driving around without helmets on.
Oh.
Which is really weird when you see it on like in real, because you know here in Canada we have helmet laws, so all the motorcyclists drive around with helmets. But when you go to a state that has no helmet law, does Florida have helmet laws? I don't think they do. So when you go there and you're like looking
It's the
around
land of the
Florida,
free.
I'd be shocked if Florida has a helmet law. Let's look here. Oh, under 21 you have to wear a helmet.
Well, see, they're being reasonable. At 21, you take off your helmet and crack open a beer.
When you're old enough to buy alcohol for yourself, you don't have to wear a helmet.
I know.
Yeah.
How crazy is it? Like, how crazy is it that they allow people to go to war, but they don't allow
At
them
18.
to drink?
I know, that's insane.
Yeah.
I
That's
feel like
insane.
you have to. That's an arb that just shouldn't exist on the from the government's perspective.
Yeah.
One or the other. Either you tell them that they can't go to war till 21, or you tell them they can drink at 18.
Yeah.
Yeah.
It's just not. It's just not allowed. Doesn't seem right to me.
It's weird too because you can buy cigarettes when you're 18, but you can't buy alcohol until you're 21.
Well, remember here in Canada, I don't know what it is now, but in our day, it was 16. You could buy cigs, right? Patrick, you remember that?
Yeah,
right?
no, I remember that.
It was
Yeah,
16.
Holy shit.
And not only that, nobody cared. It was like Quebec. It was like, Quebec, they'll sell beer at the Dépanneur to a 12-year-old.
Yeah.
You just tell them it's for your dad. Like it's. But that was how cigs were. Like you couldn't do it.
Oh, wow.
I was telling my
Yeah.
kids the other day about how, remember when we would go to a bar, Patrick, and you'd come home, and even if you weren't a smoker, your clothes would just reek?
Oh.
Yeah.
Oh, you remember that, Lena? Like
Oh,
you're
yeah.
old enough to.
Oh yeah. The next
Oh, it
morning,
was- Oh,
the hair,
it was just-
the pillowcase, everything just reeked. You have to just wash everything.
It was just wild to think about it. It's
Yeah.
just crazy. Now you
The
reek
good
a
old
pot.
days.
You just reek a pot now.
Yeah. Basically.
Yeah. I
Basically.
saw someone the other day say they came to Canada, they came to Toronto, and they were like, God, I couldn't believe how much pot I smelled everywhere.
In Toronto.
Well,
Like, I was like,
no,
okay.
it's kind of legal, right? So it's
Well,
like,
yeah, you do
You
smell
gotta
a
go
lot
to
of it.
Vancouver.
But I don't know. Like, I don't know if they're any worse than us. I have a question for you. Do you like the smell of it?
well, no.
Really?
The smell
Because
of
I
pot.
actually like this. Yeah, I like the smell of it better than the actual doing it.
No, I don't like it.
do. I like
I
the
don't
smell
like the
of it.
smell.
I don't see why anyone's like every now and then someone gets some like really skunky stuff that's kind of gross. But if you get nice ones, like it's nice. I'll
You just like the buzz you get from like. What is
from
that
just
smell?
like
Let me get.
I
let me go closer here. Oh, you guys are hotboxing. Let me just have a
Give me
quick little.
just a little taste.
Just a little hit. No problem. It's legal. It's all good. I just like the smell.
Okay, well,
Anyway.
Patrick's got to go.
Yeah.
So we'll
All
let him
right.
go. Thanks for tuning in, everyone, and we'll see you in a couple of weeks.
Have a great weekend, everyone. Cheers.
Bye-bye.